Investing can be intimidating, especially for beginners who are used to keeping their money in a traditional savings account. While savings accounts are popular for their simplicity and security, their returns are often limited, which may not be sufficient to meet medium and long-term financial goals. Safe investments are those that offer a low risk of capital loss. However, it's important to understand that safe doesn't mean risk-free, but rather that the risks of significant losses are minimized. There are several investment options in the U.S. market that can provide better returns than a traditional savings account, while keeping risks under control. One important concept for new investors is diversification. This means not putting all your money into a single investment. Diversifying across different types of assets, such as high-yield savings accounts, treasury securities, and certificates of deposit, CDs, can help balance risks and increase your chances of earning good returns. Before investing, it's essential to acquire a basic understanding of the financial markets. Financial education allows you to make informed decisions and avoid common pitfalls, such as fraudulent investments or financial products with hidden fees. Many resources are available, from online courses to books and financial advisors, that can help you build this foundational knowledge. Practical example: suppose you have $50,000 available to invest. Instead of placing the entire amount in a single investment, you could distribute it across different safe options, such as $20,000 in a high-yield savings account, $20,000 in treasury bills, and $10,000 in CDs. This diversification strategy helps protect your capital while seeking to maximize returns. High-yield savings accounts have revolutionized personal finance in the U.S., offering a modern and accessible alternative to traditional savings accounts. These accounts are typically offered by online banks, which can provide higher interest rates because they have lower operating costs than traditional brick-and-mortar banks. In addition to offering better returns than traditional savings accounts, high-yield savings accounts are convenient and easy to use. You can manage your investments directly through the bank's website or mobile app, transfer money, pay bills, and perform other financial transactions without needing to visit a bank branch. One well-known example of a high-yield savings account in the U.S. is Marcus by Goldman Sachs. With competitive interest rates, Marcus has attracted millions of customers by offering a straightforward and transparent experience. One of the major advantages of Marcus is its automatic interest accrual, which ensures your money grows over time without any additional effort. Marcus also offers other features, such as the ability to create financial goals, track your progress, and organize your finances more effectively. Practical example: imagine you deposit $5,000 in a Marcus high-yield savings account. With an interest rate of around 4% as of 2024, you would earn about $200 in interest over a year, significantly more than what a traditional savings account would offer. The flexibility of being able to withdraw your money at any time makes this option ideal for those who need immediate liquidity. Another standout in the high-yield savings account market is Ally Bank. Known for its customer-friendly approach, Ally Bank offers competitive interest rates, no monthly maintenance fees, and a variety of financial tools to help customers manage their money. Ally Bank also differentiates itself by offering a user-friendly online platform, making it easy to access and manage your savings from anywhere. The bank's reputation for excellent customer service and its wide range of products make it a solid choice for those looking for a reliable high-yield savings account. Practical example: with $2,000 deposited in an Ally Bank high-yield savings account, you could earn approximately $80 in interest over the course of a year, while enjoying the convenience of easy transfers, bill payments, and other financial services, all from a single platform. Treasury securities are another excellent option for safe investing, especially recommended for beginners. These are bonds issued by the U.S. government, providing a very low risk of default. Treasury securities are considered one of the safest investments available. Among the Treasury securities, Treasury bills, T-bills, are the most suitable for those seeking security and liquidity. T-bills are short-term securities that mature in 1 year or less, and they are sold at a discount to their face value. The difference between the purchase price and the face value represents the interest earned. One of the significant advantages of T-bills is their high liquidity. You can sell them in the secondary market before they mature, which makes them ideal for an emergency fund. An emergency fund is a reserve of cash that you keep for unexpected expenses, such as medical bills or job loss. T-bills are perfect for this purpose because they combine safety with a return that is typically higher than what you'd get from a traditional savings account. Practical example, suppose you have an emergency fund of $30,000. By investing this amount in T-bills, you'll have a safe investment with a return slightly higher than a savings account. If the T-bill has a yield of 5% and a one-year maturity, you would earn approximately $1,500 in interest, which is much better than keeping the money in a traditional savings account. Besides T-bills, the U.S. Treasury offers other types of securities, such as Treasury notes, T-notes, and Treasury inflation-protected securities, TIPS. T-notes have maturities ranging from 2 to 10 years and pay interest every 6 months. TIPS, on the other hand, are designed to protect your investment against inflation by adjusting the principal according to changes in the Consumer Price Index, CPI. Practical example, if you invest $10,000 in a T-note with a 10-year maturity and a 4% annual interest rate, you'll receive $400 in interest each year, plus your original investment back at the end of the term. This provides a predictable and secure income stream over the investment period. Inflation is one of the most significant factors that can impact your investments. It represents the general increase in prices over time, which means that the money you have today will be worth less in the future if not invested properly. Understanding how inflation affects your investments is crucial to protect and grow your wealth. When inflation is high, the cost of living increases and the value of money decreases. If your investments do not offer a return higher than the rate of inflation, you are effectively losing purchasing power. For example, if inflation in a given year is 6% and your investment returns 4%, you experience a real loss of 2% because your investment earnings did not keep up with the rising prices. A clear example of this occurred in 2022 when inflation in the U.S. surged due to supply chain disruptions and other factors. Many investors with money in low-yield savings accounts or bonds with returns below the inflation rate saw their purchasing power decrease, highlighting the importance of seeking investments that outpace inflation. Practical example, suppose you had $100,000 invested in a bond yielding 2% annually. With inflation at 6%, at the end of the year, your money's purchasing power would have decreased by 4%, even though the nominal value of your investment increased to $102,000. This scenario illustrates why it's essential to seek investments that offer returns higher than the inflation rate. To protect your investments against inflation, consider products that offer real returns, meaning they guarantee a return above inflation. Treasury inflation-protected securities, TIPS, are an example of a security designed to shield your investment from inflation, as their principal adjusts with changes in the CPI. Practical example, if you invest $50,000 in TIPS with a 10-year maturity and a fixed interest rate of 1% plus inflation, your investment will grow in real terms, ensuring that your purchasing power is maintained or increased over time, even if inflation rises. Investing with long-term goals in mind is one of the most effective strategies for building wealth and achieving significant financial objectives, such as retirement or funding your child's education. TIPS are an excellent option for those with these goals because they offer protection against inflation and provide a real return over time. TIPS are Treasury securities that pay a fixed interest rate plus an adjustment for inflation based on the CPI. This means that no matter how high inflation rises, your investment will be protected and will continue to grow in real terms. TIPS are particularly suitable for long-term investments, as they ensure that your money will retain its purchasing power and grow over time. By investing in TIPS, you can align the maturity of the security with your financial goals, such as the year you plan to retire or when your child will start college. Long-term financial planning is essential to ensure that you reach your goals. Investing in products like TIPS helps mitigate the risks of losing purchasing power over time, providing a solid foundation to achieve important milestones. Practical example, if you plan to retire in 2040 and want to have a supplemental income in addition to Social Security, investing $100,000 in TIPS with a 2040 maturity date and a fixed interest rate of 1% plus CPI adjustments could result in a significant sum by the time you retire. This will help ensure that you maintain your standard of living during retirement, even with inflation over the years. Certificates of deposit, CDs, are time deposits offered by banks and credit unions that provide a fixed interest rate over a specified term. CDs are a popular choice for conservative investors looking for a secure investment with a higher return than traditional savings accounts. Types of CDs: fixed rate, variable rate, and bump up. There are several types of CDs available in the US market. Fixed rate CDs. These offer a guaranteed interest rate for the term of the deposit, providing security and predictability. Variable rate CDs. These CDs have interest rates that can change over time, usually in response to changes in a benchmark interest rate. Bump-up CDs. These allow you to increase your interest rate once during the term if rates go up, offering some flexibility in a rising rate environment. One of the major advantages of CDs is the protection provided by the Federal Deposit Insurance Corporation, FDIC. The FDIC insures deposits up to $250,000 per depositor, per institution, providing an additional layer of security for your investment. Practical example: suppose you invest $50,000 in a 2-year fixed-rate CD with a 5% annual interest rate. At the end of the term, you would earn $5,000 in interest, resulting in a total of $55,000. This is a safe investment option with a predictable return, protected by FDIC insurance. CDs come with a fixed term, meaning you agree to leave your money in the account for a specific period, ranging from a few months to several years. Early withdrawal usually incurs a penalty, so it's important to match the term of the CD with your financial goals. Practical example: if you're planning a large purchase, such as a down payment on a house in 2 years, investing in a 2-year CD could be a smart strategy. You'll earn a higher interest rate than a savings account, and you'll know exactly how much money you'll have when it's time to make the purchase. Investing safely is a journey that begins with knowledge and financial education. By exploring options like high-yield savings accounts, treasury securities, TIPS, and CDs, you're laying a solid foundation to build and protect your wealth. Diversification, long-term planning, and understanding factors such as inflation are essential to ensuring that your investments align with your financial goals. Remember that while safety is important, regularly monitoring your investments is crucial to adjusting your strategy as needed and maximizing returns. With the right information and tools, you can make your money work effectively, ensuring a more stable and prosperous financial future.